The case study for account receivables and how the allowances are accounted for in the annual report goes as follows. The example we are going to take is Toys for You. This is a company which is basically manufacturing toys, and just to simplify everything here, we are taking some assumptions. Number one, all customers buy on credit and pay cash the following year. So in the first year they buy on credit and pay cash on the following year if they are not bankrupt. Number two, any uncollected receivables are then written off. Number three, the management provides us with these details that based on their experiences, Toys for You books 10% of its receivables outstanding at the end of the period as an allowances for bad debt. Number four, there are no other costs. That is, cost of goods sold is zero. I mean, obviously this assumption doesn't hold true, but here for the sake of example we will take this. 5 is the actual write-offs differ from the expectation in this way, that the sales is $100 in year 1. However, the actual collection, as the cash collection happens the following year, the actual collection is given in year 2, which is 90 here. So this is the bifurcation of how the sales are recorded and actual collections are taking place. So we are only taking an example of 2 years, and what we are expected to do is to create an income statement, balance sheet and cash flows at the end of year 1 and year 2. So let's try this out and see how it goes. Let us now work on the income statement, balance sheets and cash flows for this case. Let's start with year 1, income statement. Income statement obviously starts with sales, and sales here would be $100, and the reason we are recording $100 here even if we have not yet received cash is because we are following a method which is known as accrual concept of accounting, and this was introduced earlier in our introduction to accounting lectures. The second is basically cost of goods sold. Cost of goods sold here is 0 because this is the assumption that we have already made. The other kind of expense that actually comes here is related to the bad debt expense, and bad debt expense is related to the accounts receivables. Now during this period, which is year 1, the bad debt expense, which is essentially the management estimates of the bad allowances, will be considered because this sales has happened in this principal, and the expense should be matched with the corresponding period when sales has happened. So bad debt expense was the estimate provided by the management, and this was 10% of the sales. So this is 10% of 100, which is equal to 10 here. So bad debt expense 10% multiplied by 100. So this is bad debt. So we'll assume that the taxes is at 0% so that this stays at 0 and doesn't introduces other set of complexities. And finally the net income here would be sales minus COGS minus bad debt expense minus taxes. So the net income here is $90 in this case. Let us now quickly work on the balance sheet. Please note that this is a very simplified version of the income statement, balance sheets and cash flows which we are working on. Here we are only discussing how the selected item like changes in account receivables will affect the 3 statements. So that's why other items are taken in a very simplified way. So let's talk about assets. Assets actually starts with cash. So in year 1 we have not yet received any cash, so this would be 0. The other form of assets which we are assuming here is only accounts receivables. And how much was the accounts receivables? Original account receivables would be $100 because that all the sales that actually happen is on the credit. So this would be $100. Now what is the management's estimate for allowances? So allowances essentially is what we had calculated here as $10. This is the management estimate. So this lowers down your accounts receivables. So the term that comes here is net accounts receivables. So this is 100 minus 10, which is $90. So we are assuming that other form of assets are not there. So the total assets here comes out to be net account receivables plus the cash, which is 90. So this is the asset side. So let's look at the liabilities side as well. Liabilities actually starts with debt, and we'll assume that these are 0, and so as no complexities are introduced at this stage. The other term that is important here is shareholders equity, and within shareholders equity we have a term called retained earnings. Now what is important for us to note here is the linkage between the income statement and the balance sheet. We have earlier discussed this in our case study. However, to reiterate, retained earnings is linked to the income statement. So here this would be linked to the income statement because net income is what all flows to the shareholders equity. So this is equal to 90, and hence the total liabilities comes out to be retained earnings plus the debt, which is equal to 90. So total assets are equal to total liabilities. Please note here that while we were talking about linking retained earnings to the income statement, any previous retained earnings are also added up. So here the previous retained earning was 0. So we have not added anything, we have just directly linked the income statement. Okay, so this is the year 1 balance sheet. What about the cash flows? Were there any collection during year 1? As we note from this case, there were no cash flows. This was 0. So cash flows actually are 0. So here we have completed the year 1 income statement, balance sheets and cash flows. In year 2, sales is $150 and actual collections is 90. So let's draw the income statement. Sales as given is 150. COGS would be 0. Obviously we have assumed that there is no cost of goods sold, and bad debt or bad debt expense here would be the management's estimate of the allowance. So here the allowance would be 10% of 150. This comes out to be 15. So I'll write 15 here, and taxes again for the sake of simplicity assuming it to be 0. So the net income comes out to be 150 minus 0 minus 15 minus 0. So it is 135. So let us now make the balance sheet for this company for year 2. Now on the asset side, the starting place is cash. So what did we receive in cash? If you look at the actual cash collection was 90. So here it would be cash collection is 90. Now the second item was accounts receivables. So earlier account receivables was 90 in year 1. However, this 90 was received in the format of cash. So it came back to 0 from account receivables and it became 90 in cash. So the fresh account receivables were 150 because all the sales that happened are credit sales. That's what we have assumed. What are the allowances? Allowances is basically 15. That is what we have taken this in the income statement. So the net receivables will be 150 minus 15, that is 135. So the total assets comes out to be $90 plus $135, that is $225. Now this is the asset side. What about the liabilities? The liabilities actually start with debt, and again here this will be 0. The second item which we had taken earlier was shareholders earnings or shareholders equity, where we talked about the retained earnings. The original retained earnings was 90. So this basically is linked to the income statement. So the income statement net income is 135, and as we have discussed earlier, retained earnings total is retained earnings of the previous year plus the net income of the current year. So this is 135, which is the net income of year 2, plus the retained earnings of the previous year, which is 90. So this comes out to be 225. So our total liabilities here is 225 plus 0. So total assets are equal to total liabilities. Now what about the cash flows? The cash flows, as we have seen earlier, actual cash collection is 90, and that is why we have 90 here in the cash item within the balance sheet. So cash flow here is $90.